Thanks for joining us today on Market Call. I'm Morello Fernandez. Mike Vinokur with us on the show, portfolio manager, senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. He'll take your questions on North American large caps. Here's how to reach us. 1-855-326-6266. Market Call at BNN Bloomberg.ca if you are emailing us. Mike, good to see you. Thanks for coming in.
Oh, pleasure to be here.
I know you've been expecting a correction for some time. What have you been doing to prepare for that?
So what we've been doing is we've been making sure that the positions that we have are still solidly undervalued, margin of safety, pure sort of value manager 101. But we were also raising a lot of cash. And we, of course, did not know that a catalyst for the correction may be this incursion into Iran. We were just a little bit concerned that after 3 years of great markets, valuations were perhaps a little bit fair to overvalued. And we just wanted to raise a little bit of cash and see if there was some kind of corrective action, especially in the more frothy areas of the market, which in our view were mainly in the tech space.
So let me ask you whether or not once that catalyst of the war started in the last month, if you've altered the way you're going, changed direction at all? What have you done in the past 4 weeks?
In the past 4 weeks,
we
bought one position in the tech space, which is one of my top picks. So we'll save that for later on in the show. And we continue to raise cash, and we are now ready to buy. We have a bunch of orders in. Obviously, today markets are rebounding, but up until yesterday, it looked like everything was coming toward our bid prices. And so we're ready to pounce.
Okay. So will the end of the conflict, you think, be a reset, sort of the end of a correction, or has it gone too long that we're undoubtedly going to have a lot of fallout in the markets?
So the market is battling a few things. Obviously, the war is taking up a lot of airtime, as it should, because there's a lot of destruction going on and probably a lot of other things that we don't yet know of. For example, backup in logistics on fertilizer, which may impact growing season, et cetera. You know, they're still on page 16. They're not page 1 news items yet. But having said that, we still have issues in the private credit market. You know, you've got a lot of funds that have been gating. Yeah, you've seen those headlines. There's now more news on credit defaults within the banking space. You've got some layoffs this morning I saw from Oracle yet again. So, you know, low hire, low fire type of environment. So maybe not a lot of net new jobs created. For now, not too many layoffs, but we'll see. So there's a lot of things in the background that are still causing the market to potentially have a little bit of jitteriness and really looking at that valuation.
Okay, let's take a quick break. We'll line up the first phone calls for Mike Vinokur, Propellus Wealth Partners, taking your questions on North American large caps. Back in a moment. Welcome back. We're going to start with an email from Stu, who says Brookfield infrastructure seems to be in a decline. Any idea why? Well, everything's in a decline, I kind of want to say, but it did have a high at the end of February, it looks like, and then has been trending down. Do you like any of the Brookfields?
We have been looking at one of the Brookfields.
Was this the one?
No, this was not the one.
Okay.
No, haven't been a fan of this one, not from a operational perspective. From an operational perspective, I think they've done an amazing job. The challenge for us with Brookfield Infrastructure Partners and some of their other baby Brookfields, if you will, is they pay a distribution and they constantly are reinvesting the free cash flow into new projects. And it seems to us that when you look at the cash flow that they use to pay the distribution and they look at the cash flow to run their business, they're constantly dependent on generating capital gains and flipping over projects in order to continue the business.
Okay.
There's no, from our perspective anyway, no real free cash flow on a net basis, like say on a typical utility, which is fine if you can make the argument that they can continue developing, flipping projects, realizing gains on sale, paying the dividend, etc. The other issue is the backup in interest rates really hurts a name like this potentially because it's very interest rate sensitive. They obviously need to constantly borrow money to redevelop new projects. And so that may be part of the reason that it's gotten a little bit hit.
Okay, so just keep that in mind if you're looking to pick it up. But otherwise, you mentioned you're looking at other Brookfields for your fund.
One of the
others.
Brookfields, yes.
Okay, let's get to Bill then. Bill has written in. He says, "I'd like to know about TELUS stock. Is it a buy now or hold? I've had a lot of different people talk about TELUS. What is there? The dividend. I know there's concern about the dividend, but people like it for the dividend. Would you buy into TELUS? Do you hold it at all?"
So we don't own TELUS in the equity model. We, full disclosure, own Rogers. That's been our preferential way of having some exposure to the telecom sector in Canada. We think TELUS is a good operator. They've had these interesting machinations, if you will, where they'll spin out a division, they'll buy out a division, TELUS Digital and Health and this and that, and they're all over the place, which could be a good thing if it's managed well. We think they've had a lot of stumbles along the way, and the reality is that the dividend takes up all of the free cash flow, maybe even then some. So the question is, can they grow into their dividend distribution and sort of pay down some debt and leave some net cash on the balance sheet? That's been the question. The dividend is huge. So one may argue that if they don't cut the dividend and you just buy the stock and hold, I think it's yielding like 8.5%, 9%. So that's a pretty good return, especially in a non-registered account for a Canadian investor with the dividend tax credit. Having said that, we are concerned that it's been a very long time that they've been paying this dividend that is more than what they're actually earning on a free cash flow basis. And so we're not quite sure if maybe a la BCE, there may be a dividend cut to reset the decks.
So definitely think about that if you're going in for the dividend itself.
Absolutely.
Okay. Let's move on to a caller on the line. Chris is in Delta, BC. Chris, go ahead.
Well, thank you, Morella, as always. Mike, I'd like to ask you on Premium Brands Holdings. A few of the guests speak about this company, not many. It's one that I followed for about 5 years now. They actually, they're definitely not a dividend aristocrat by any means, but they have a very good dividend payout history in terms of raising and not cutting and consistency. They do also run a very leveraged balance sheet, but they have growth projects with their distribution facility finishing in the U.S., an assortment of brands that some we will recognize and some we will not. The stock has come down quite a bit recently, and I'm wondering if this would be an opportunity for a long-term investor to add. Thank you so much. I'll hang up and listen.
Thank you for that question. What do you think of Premium Brands?
Thanks for the question. Full disclosure, we own Premium Brands in the model portfolio. We quite like it. Not liking the stock action, obviously. We got in last summer. I forget what we paid, somewhere in the $88, $90 range, if my memory serves. We're quite fond of management. We think they've been very good allocators of capital. The caller is right. The dividend has been good. It's yielding today, I think, somewhere in the vicinity of 3.4, 3.5%, in that range. We love the fact that they are
4.2.
Oh, 4. There,
wow,
you go. Well,
okay.
Because of the drop in the price, I guess. This is a company that I think 10 years ago was doing $500 million in sales, and I think they're edging closer to 9 or 10 billion. Now, that's been a combination of acquisitions, tuck-in acquisitions, bigger acquisitions, and some of their own product growth. We like their strategy in that they're now both sides of the border. And so when you think about tariff impacts, there's very little on the tariff impact side. Obviously, the U.S. is a much bigger market than the Canadian market, so now they're able to access that. This management team has proven to be able to eke out the synergies from the acquisitions that they've made. And yes, the caller is right. The balance sheet is a little bit stretched, especially with this latest acquisition that they've made. I think it's called Stampede, if memory serves. But you know what? This management team has had a proven track record of taking the cash flow, paying down the debt, right-sizing the balance sheet, buying back stock. And so we like it. We think it's a good long-term hold.
Has it dropped down, or why has it dropped down? Again, we talked about everything getting pulled down, but any specific reason why premium brands itself has moved?
I think that they may have slightly missed on revenue numbers when they reported the quarter. We don't look at things on a quarter-to-quarter basis. We're more of a 2 to 5 year investor. Depending on fair market value, we think that there's a huge margin of safety at this price. We like the earnings trajectory. We think that the latest acquisition is really going to bolster their EBITDA target. We think that this business could earn $7, $8, $9 a share in the next couple of years if they play their cards right and a few things work out. So you're not paying a high multiple for a quote unquote safe, recession-proof, recession-resistant business.
Let's go back to the phone lines. And Margaret's on the line. She's in Sarnia, Ontario, with a question. Margaret, go ahead.
Oh, hi there, Morella and Mr. Vinokur. Thank you for taking my call. I've been accumulating some cash and eager to step back into the market. I do watch the level of the VIX, and the other day it got up to 31, and I thought, okay, we're getting near a time to step in. And today it's popped right back down into the 20s. So I'm sort of sitting on my hands. Do you look at the level of the VIX at all to determine when it's an entry point, or do you just look at the level of a stock? So thank you. I look forward to your opinion.
Thank you for the question. Yeah. So 27th is when it was spiked up to 31, as you can see, down to 27 today. Do you look at the VIX?
We do look at the VIX, but only from the perspective of the general market posture. The caller is right, Margaret. Thank you for your question. Look, if you are trading the broad-based indices, and the VIX specifically relates to the S&P 500, and it's the volatility, if I'm not mistaken, the average 30-day volatility of options, right? Okay. So, and now that there's so much of these ODTEs, the 1 day to expiration, the VIX doesn't really pick up the volatility interplay on the 1 day, 3 day, 5 day. It's really a 30-day. But, everybody knows the VIX because it's been around for so long. I'm not 100% sure that it's the end-all be-all indicator that it once was, perhaps. But like I said, when we're looking at broad-based indices like the S&P 500, we do look at the level of the VIX to see where it's at relative to its shorter-term history, to see how much people are bidding up options prices and where the fear gauge is in general.
What does that tell you? Does that tell you when to step in?
So generally speaking, the VIX trades between 10 and 20 in a normal sort of uptrending market. When you see the VIX going up above 20, between 20 and 30, you normally have a spike in volatility. When you see the VIX above 30, the spike in volatility generally tends to expand. And normally, when you go back in history, the spike between 30 and, say, 40, 50, 60, I think the peak it ever hit, and I forget if it was in 08 or during COVID, was 80. But that was like a split second, and then it came right back down. So, I guess a good course of action is, generally speaking, if you have a longer-term view. If the VIX is below 30, you may want to step in. If the VIX is between 10 and 20, it's probably reasonably safe. And if it's above 30, then maybe that's a yellow light to a semi-red light. You may want to wait to see if it spikes to 40, 50, get that extreme measure, and then it's probably a good time to step in.
Let's take a quick break on that note. We're going to be back with Mike Vinokur, Propellus Wealth Partners, IA, Private Wealth, taking your questions on North American large caps. Here's how to reach us. Back in a moment. Welcome back to Market Call. Charlie has been holding on the line. He's in Montreal. Go ahead, Charlie.
Yes, thanks for taking my call. I'm calling about Canadian oil stocks. For example, Cenovus. My real question is, do you think it's a good idea to trim these stocks, either before the war ends or when the war ends, or do not trim at all? Thanks.
Okay, thank you for the question. Again, I'm interested in hearing what your perspective is. All the energy stocks have spiked after being pretty sort of lackluster last year.
Yep.
But we are where we are. So what would you do in the energy file right now?
Okay, so we're being very selective on energy stocks. And to us, it seems like no matter what happens, so when I say no matter what happens, we believe eventually this war is going to end. We don't know when and we don't know exactly the circumstances, but eventually it's unfathomable to us that, the Strait of Hormuz is going to be blocked forever and a day. That just doesn't work for the whole world. So when the Strait of Hormuz is unblocked by whatever method it does happen, we think oil prices will pull back because it's not a supply issue, it's a logistics issue. Mm-hmm. And when those logistical corridors come back, supply will come back with a fervor because those producers are really going to want to capture that premium. Okay. So the issue for us is in North America, we're very endowed with energy and we're very lucky in that regard. However, we also have a maximum amount of capacity to export, and we only have a certain amount of domestic demand for what we need. And that's why right now you're seeing that big divide in the price of WTI versus the price of Brent. And based on what's happened in the Strait of Hormuz, we think that potentially that Brent WTI spread is going to be much bigger for a much longer period of time. So say, for example, tomorrow the war ends, they make peace, there's a ceasefire, transits come back. Well, we would think that WTI can come back in a large amount, maybe $15, $20, whereas the price of Brent will probably also come in, but we don't think it'll come in as much. So what do you do with that? Well, ideally, you want to favor producers that can access the Brent price because all of a sudden, for the foreseeable future, for the same amount of effort, if you will, they will have a much bigger spread or premium to their sale price. So that's number one.
How do you access Brent?
Okay. So, for example, Cenovus is a good example of what we like. Why? Not necessarily because they can access Brent, but because they have refineries. And due to the crack spread opening up for refiners, this is an example of a company that has a very, very long reserve life because of their tar sands. I believe they do have some natural Brent exposure off the coast of Newfoundland, if I'm not mistaken. But at the same time, they're benefiting hugely from the refinery crack spreads. So we think that this is going to be a great story, and people are going to prize the stability of a producer like this, onshore Canada, very long life reserves, and the crack spread that's probably going to be with us for a longer period of time.
Okay, so be careful what you're choosing and how you're looking at it down the road. Let's get to an email from Alan. Would your guest be able to give his outlook for Blue Owl Capital? We'll pull up that line chart right now. Blue Owl sort of tanking, I guess, on the same concerns on private credit. Do you like Blue Owl? Would you pick it up where it is today?
So we were looking at Blue Owl, full disclosure, and for the time being, we've decided to press the pause button on it. Nothing necessarily pertaining specifically to Blue Owl, but it's been sort of the poster child in the beginning anyways for this gating, well, maybe they're going to call it Gate. I don't know, whatever nickname they're going to come up with. But, there's been a lot of private equity, private credit funds that have been gated recently. And we're not sure if the tide, not if, but when the tide is going to turn. So the question is, does a company like Blue Owl have the ability to keep on raising what's called fee-related AUM to continue that that path of growing their earnings. Right now, they're paying out a huge dividend, and that dividend is pretty much eating up all of their earnings, to our knowledge, last time we looked. So you have to make a bet here that everything stabilizes in the private credit, private equity market, number one. Number two, there aren't any black swan events within their book of business that happen just because we're heading into a potentially contractionary economic cycle. And three, that they're going to be able to start raising AUM capital again, which will feed into their earnings stream, which will allow you to expand the valuation. Again, nothing bad to say about the management of Blue Owl. It's just we are where we are. Yeah, I mean, Blackstone, KKR, Apollo, Carlyle, Onyx, they've all been hit, right? The question is, which players, if any, do you want to be in that space?
Let's take a quick break on that note. We'll go through some past picks from Mike when we come back. Welcome back. Time to go through past picks from Mike from March 7th of last year. At the time, he chose Corebridge, CRBG, Corebridge Financial in New York, 32.04 at the time US, 23.16 today. So 28% downside, 24% in total return down. This is essentially insurance.
Yeah.
What's been happening with them?
So a lot of the life cos have been getting hit more recently, along with the typical downturn. But more so, we think that the market is worried about some of these life cos having exposure to what we were talking about before, which is private credit, and what percentage of the book is potentially exposed, impaired. How is that all going to play out? We think that Corebridge is a very well financed company. They just announced last week that they're going to be merging with Equitable Life. So this company is going to become a much bigger entity, huge market cap, huge amounts of excess capital, pays a nice dividend. They earn, I think they're going to do $5.50 a share as a standalone entity. So right now it's trading at 4.5, 5 times earnings, and it's trading at less than tangible book value as of the last quarter. So we still like it very much and own it.
Okay, let's get to your next pick, Parkland PKI on the TSX, which was, of course, acquired by Sunoco October 31st of last year. It was 36.35 at the time and then closed at 39.84, so 10% upside, 13% for total return. We'll pull up Sunoco as well and just see where they are today. Do you remember when you picked this up and what you liked about it? There was investor action. There was a lot going on behind the scenes.
That's right. So I think we paid an average of $34, $35. We waited a couple years, collected some dividends. There was some activism. And then Suncorp or Sunoco came and bought Parkland. We accepted part cash, part shares. Happy we did, because the stock has done very well since the acquisition. It's a great business. Perhaps the capital allocation with the previous management wasn't as good as it could have been. We thought the assets were phenomenal. We like the combination of assets, especially now, given what's going on in the refining space. And they're basically a company that distributes and is right in that business. So their margins must be going through the roof at this point.
Sunoco and Parkland there. Let's get to your last past pick. Secure Waste Infrastructure, SES on the TSX. At the time when you chose it, it was at $13.89 to $22.50, so it's done really well. 62% upside, 65% for total return. What have they been doing? What has let their stock move up the way it has?
So look, it's a phenomenal management team. They've been buying back stock. They've been investing. Full disclosure, though, we did sell out just below this price here, maybe 10% ago or so. Nothing wrong with the company itself. We just wanted to take that cash and build up a cash reserve for the correction that we were talking about at the top of the hour. We felt that perhaps Secure was closer to our estimated fair value. We probably should have waited a little bit longer, but That's how it goes sometimes. But we like this company because it's got a lot of infrastructure assets, as the name sort of implies. And so I think 80% of their cash flows are sort of recurring. So it's a very steady Eddie business, allowing them to take a lot of cash flow and reinvest.
And clearly no one's getting rid of waste easily. We're all putting out more and more waste. Oh, we've forgotten about that fight. Let's take a quick break. Mike Vinokur here with us today, Propellus Wealth Partners, taking your questions, North American large caps. Back in a moment. Welcome back. Let's go to Kevin. He's in Kingston, Ontario. His question today. Kevin, go ahead.
Hello. Thank you for taking my call. It's regarding the TD Bank. It's had a really good run over the last 10 months, and I'm just wondering if you would be a buyer at its current price, or would you wait for a different price, and what price that would be? Thank you.
Thank you for the question. People have benefited very much from that run-up since TD paid that penalty in the U.S. and kind of got pushed back and now has bounced back. What would you do with TD?
So we're not a big, we're not big on the Canadian banks right now. Not because they're not great operators. I mean, TD is a phenomenal operator. There's no question. It's just about valuation. We don't think they're cheap relative to historical standards. Some people have made the argument that, well, you know, these things are such behemoths that, you know, historical standards, throw them out the window. We're in a new environment. Well, that's all and good, except we still think that we're in a credit cycle. That cycle hasn't necessarily run its course. And when it does come home to roost, you're going to see if these banks have had enough credit reserves or not, and how that's going to affect the economy, how that's going to affect their earnings. So again, if someone is willing to, you know, own this thing, close their eyes for the next 10, 15, 20 years, they'll probably do okay. As a value investor, we just don't see the margin of safety, and we prefer to not be in the specific banking field right now and maybe go into another part of the financial services industry.
Where are we in the cycle? And I know you can't really answer that. I'm just going to ask about your gut feeling about where we are. And we haven't seen the big financial companies yet affected, meaning the banks.
Right.
So where would we be in that cycle?
So that's a tough question because given the fact that the demographics of Canada are such that we are right now at the highest percentage in recorded history of over age 65, which means that maybe, just maybe, the next cycle from an unemployment perspective isn't going to be as bad because you're going to have maybe a lot of people retiring, a lot more than in, let's say, previous cycles. Mm-hmm. And so you're seeing in the US this low hire, low fire mm-hmm. type of environment. Maybe that's part of it, right? But you're definitely seeing a slowdown in GDP growth. And we think that there's going to be more of that. You're seeing real estate market slowing down. Manufacturing is not as robust as it was. And the unemployment rate in Canada, I think, was 6.7, 6.8, yes. and moving up. And we're starting to see a lot more firings or layoffs in the white-collar space. And those are typically jobs that have much higher earnings. So it's going to be in wait and see. I would say, if you're looking at baseball analogies, we're maybe in the 6th inning, in the 7th inning, but there's a couple more to go. And we just want to see the whites of the eyes of that cycle to see, have we hit bottom? And it may need to wait another 12 to 18 months.
Let's go back to the phone lines. Bob is in Penfield, New Brunswick, with a question. Bob, go ahead.
Thanks for taking my call. I was just wondering if I could get your thoughts on NVIDIA for the remainder of 2026 and moving forward. And also, what would be an attractive entry point at these levels? Thank you so much.
Okay, great question. 170.80 today. It's going sideways for quite a while now with the dip for tech and everything else. It's sliding. Would you pick it up today?
So full disclosure, we are looking at it. Haven't been ready to pounce for a couple reasons. One, our target entry point is lower than where it is today. I won't say the exact price, but let's say much more than 10% lower. Okay. And part of the reason that we're not jumping at the bit here is we have the concern about helium. So helium is a very important gas in the manufacture of semiconductors. And approximately 25 or 30% of the world's production of helium transits the Strait of Hormuz. So we're trying to figure out the interplay here of, is there going to be a massive shortage of helium? If so, what is that going to do to input cost? Where are these companies going to source it? Is there going to be enough? How is that going to impact production? And NVIDIA at its core, at the end of the day, is really a widget producer, right? If they produce enough widgets, their earnings per share will go up. If they cannot produce those widgets for whatever the reason is, earnings per share will not grow as the market expects. Or it will, well, maybe the revenues will grow, but then cost pressures will seep in and the margins won't be what the market thinks it is. So again, this is not a cheap stock, but a wonderful company and certainly has a great technology. Having said that, just like in the EV space, where we always thought, yes, Tesla had first mover advantage, but don't count out all those wonderful engineering people at Mercedes and BMW and everywhere else. It's the same thing here. NVIDIA has had a first mover advantage, but don't count out Broadcom and AMD and Marvell and all of these other wonderful companies with wonderful engineering teams that may come up and, you know, if not supersede them, at least match them, rival them wit for wit, right?
Okay, that was for Bob. Let's go to an email from Frank. Frank says, Meta has recently been found guilty of creating products that led to harmful and addictive behavior. So this was the American case. They were found liable when they were sued for injuring a young girl's mental health. And they are fighting, of course, the results of that case, which also included Alphabet and YouTube. So does this present material, legal, financial, or reputational risk for the company and its valuation? I think that's a great question, because as we know, there's a domino effect with these court cases. This was one of the first. There are many to come. Right.
Frank, I wish I'm not a legal expert, so I don't know if the materiality of this. First of all, if we've learned anything from big tobacco as an example, these things take years and years and years to play out, number one. And so even if there's going to be many more cases thrown at them, by the time those cases go through the court system, this may be 5 or 10 years, who knows, and they have the right to appeal. I don't think they're going to just start cutting checks to everybody. That's not how other people in other industries have played this sort of situation. You know, Meta is a dominant platform, and they've executed on their business extremely well. Full disclosure, this is another one that we are looking to acquire. We had a bid in, and we got very close the other day. I think it was yesterday, actually. It is rallying today, so we're obviously not going to get filled on our position. We like it. WhatsApp, Facebook, Instagram, the virtual reality, and who knows what else Mr. Zuckerberg is going to come up with. This is a cash flowing machine that keeps on generating those earnings. So at a certain entry point, we'd like to be long-term holders.
And you don't think the financial hit, if and when it does come, will be for quite a long time?
Well, I don't know that for a fact, but I do think that whatever the financial hit is going to be, it's probably going to be manageable for the company to allow to make those payouts and still grow the business.
Let's take a quick break on that note. We'll be back with Mike Vinokur to answer your questions in just a moment. Stay tuned. Welcome back. Let's go to Sam. Sam's email. He says, what is your opinion about Netflix? Is it a buy at this price? Netflix got a bounce after it dropped its Warner Brothers bid, as you know. Do you like Netflix? I think it's in the 90s now. Let me have a look at that line chart. But what would you do if you were holding it? Would you dip in and buy more?
Thanks for the question, Sam. So we don't own Netflix. We have started to look at it. We were concerned with this bidding war with Paramount. And now that it's over and Netflix is back to basics, we're looking at it. Certainly, we're, in my household, big users of Netflix.
As are a lot of households, yes.
And it's quite addictive. So as a user for myself and my family, definitely a good product. Now, the question for us as equity investors is it a good equity investment? Is there enough of a margin of safety? I like the business. We're still doing work on the valuation. I can't say definitively, but I suspect that if it had a pullback from these levels, call it in 10, 15, 20% lower, we would probably start to get more interested to become a holder. But we haven't finished the work yet, so that's a approximation.
A maybe. Okay. Let's go to Kevin's email. Kevin says, could Mike please tell me whether or not he still favors Lincoln National? Tell me about Lincoln National.
So Lincoln National is a life co. Headed under newer management. I forget the name of the woman who is the CEO. Phenomenal leader. They got hit a couple years back because of the rapid rise in interest rates, and so that made a huge dent in their balance sheet on a mark-to-market basis, as for many other life cos. We really like this company. It's got great businesses, both from their retirement business, their life insurance business. They've got a annuity business. They've got a huge capital buffer. They got a huge equity investment from one of the private equity firms last year at a much higher price. I think they paid $44 or $45 a share, bought a 9% or 10% interest, which gave Lincoln a lot of capital. This pays a very nice dividend at these rates, or these prices, I should say, probably 4.5%, 5%. And I think that they're going to earn somewhere in the $8 to $9 range. And we believe in the next couple of years that could exceed $10. So, at $35, you're potentially buying a company that's got a 3.5 times, 4 times multiple, on earnings, a really, really solid capital buffer, a great partner with this private equity firm, and solid cash flows and a nice dividend yield while you wait.
All right, that was for Kevin. Let's take a quick break. We're going to have new picks from Mike when we come back. Stay tuned for that. Join us tomorrow for Market Call. Michael Sprung will be on the show, president of Sprung Investment Management. He'll take your questions on Canadian large cap stocks. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from Mike. We're going to start with Microsoft, MSFT on the NASDAQ. You mentioned that you are watching a lot. You've put some cash aside. Is Microsoft one you're already in, or watching to pick up more, or is this a new position for you if you get in?
So we did buy Microsoft. So as I mentioned at the top of the hour, one of the capital deployments that we made recently was Microsoft. I think we bought it at the end of February or beginning of March, a little bit higher than it was trading here, but we got it at a 30+% discount off of its most recent peak. I think it peaked at 550 something, which to us was a little bit overvalued. And so we were happy with the valuation that we were get. If it pulled back a little bit more, we may elect to average down a little bit more into the name. We quite like it. I mean, Microsoft's like a utility. I don't know many people that can go without Microsoft. Maybe in the future somebody will develop another type of suite of products like Microsoft that will compete. But right now, we think most businesses, most households are using Microsoft. They're paying the annual fee, software as a service. They've got the cloud business. They've got so many other ancillary businesses that they're in. Generates a lot of free cash flow. They're investing right now a lot to compete with all the cloud competitors, and I think are doing a phenomenal job. And so at 16, 17 times forward earnings with the revenue growth that this company is putting out, we don't think it's expensive. You get a very small dividend, but it's there while paying you while you wait. And we think as the company, or rather the market, realizes the growth and the potential in the business, it's going to re-rate the stock.
It was at 542 at the end of last October, and down we saw it to 365-ish today. So you might continue to pick up more if it continues to move down.
Yes.
Okay. Let's get to your next pick. Uber. Uber on the New York Stock Exchange, a very well-known company, now is trying to partner on autonomous driving, giving sort of its platform, because it's not building cars, obviously, but is saying, here's how it works for us. Take that and run with it. Is that one of the reasons you like Uber right now?
Yeah, we don't think that the market appreciates the network effect that Uber has. So just like Microsoft has millions and millions of customers, so does Uber. Some of them are, monthly paying customers. They have this monthly Uber One plan or whatever it is they call it. But then you have a lot of customers that are the occasional Uber users. But then they have Uber Eats, and they just bought this new company called just the other day. I think it's called Black Lane. Yeah, Chauffeur, right?
For business executives.
So these guys are pretty much all over the planet, and what we like about them is it's more of a capital light business, because right now they don't own the cars. The people who own the cars are doing the driving. They're basically
they're contractors almost.
Yeah, they're well, the chauffeurs or the drivers are, but think of Uber as a matchmaker. They're matching the passenger or the delivery restaurant with the person that wants the service, and they're collecting a toll booth, right? A toll booth is a kind of great business. So that we look at Uber as more of an infrastructure business, but we think Uber has this platform that's going to be able to spawn other businesses. For example, we think advertising could be a huge business for Uber, right? Think of Amazon, right? Maybe they're going to start getting referral fees from advertisers if you click through the Uber app. I think they're even doing rentals on Uber now. So there's a lot of businesses, once you have this network effect and platform, that could be spawned off at very low cost.
Interesting.
And they have a great balance sheet, by the way.
Because you're right. We think of Uber solely as your ride service,
right,
and not much else right now. But you're right, there could be other ways to take advantage of the platform. Let's get to your last pick here, which is Manulife, MFC on the TSX. You talked about insurance and this space sort of going sideways, not being great lately. Have you picked up Manulife, or are you already holding it?
So we just picked it up for some clients that didn't have it a couple weeks back in the $44, $45 range. We like the company. Listen, great execution. They operate in Asia. They operate in the U.S. through John Hancock. They're ubiquitous here in Canada. Great asset management business. They have an infrastructure business. It's a cash cow, basically. Their LICAT ratio is very strong. I think it's 137, 138%, which means they can continue increasing the dividend, which they just did, I think, last quarter. You get a yield of close to 5%. It's trading at less than 10 times forward earnings. We think earnings are going to keep growing. They're going to keep buying back stock. They're going to keep buying up other complementary businesses and just expanding their platform. And at this point in the cycle, if interest rates stay where they are, life cos generally do better because they're making more money on their capital with interest rates higher, right? And what we like about Manulife is, other than Manulife Bank, really, they don't have much credit exposure if you're worried about, credit cycle rearing its ugly head.
Yeah, I was going to say that would be the concern for a lot of investors right now, but they're not exposed as much, you say?
Yeah, so Manulife Bank is a very small percentage of overall Manulife, and the only other exposure would be what is the extent in their book to private credit, private equity, which obviously there could be some, but we think it's going to be very small and manageable.
All right. We do have to leave it there, Mike. Thanks for coming in. Good to see you.
Pleasure to be here. Thank you for having me.
And thank you for joining us today on Market Call. We'll see you back there again tomorrow.